Are you looking to get money to grow your business? Well, you're in the right place because today I'm going to show you over 10 different ways that you can get capital to expand your business. I'm going to show you how to get money even if you have credit issues. I'm going to show you how to get approved for financing even if you're a startup, even if you're in a high-risk industry, even if you've been told you don't qualify or don't think there's any chance you can get approved. By the end of this training, you're going to know over 10 different ways that you can get money for your business, even when you can't get financing at conventional banks. And I'm going to sprinkle in throughout some information on how you can get a free fundability assessment, how you can get your business credit reports for free, how you can find out all the money you qualify for now. And if you stick around to the end, I'm also going to get you access to our funding vault of 27 ways you can get money for your business. So if you want money to grow, you're in the right place. We got a lot to cover, so let's dive in. So first of all, are you looking to expand? Are you looking to grow your business? Well, congratulations, right? It's a great thing to be dealing with, especially in an economic shift, because a lot of people right now are really focused on survival, right? A lot of people aren't focused as much on growth. I'm going to try to shut down my email here so it doesn't stop pouring in. A lot of people are still, focusing on survival and kind of adjusting to this new world post-COVID. So what's nice is that if you're focusing on growth and expanding right now, then you're already in a good position. Okay, but obviously, in order to do so, you need capital. You need to hire more people. You need to add a fleet of vehicles. You need to maybe open up another location, add more equipment, or upgrade existing equipment. Maybe you want to expand your product line, right? A lot of people right now are shifting to different things. We're adapting and overcoming, as I learned in the military, okay, to be able to adjust to a new economic condition. And the only limits really is your imagination. Well, and also your ability to get capital as well, right? Because all of this costs money. It requires funding. And the reality is when we go to big banks to get money, it's really hard. We got to have good personal credit and collateral and cash flow. And we got to verify we are profitable on tax returns and have resumes and all these things that are required to get approved to get money from the big banks. It's very tough to be able to get the money you need for expansion. And that's one of the things we're going to really dive into today. So we're going to decode these different options for expanding. Now, some that we'll dive into today include term loans. Term loans are longer term loans that keep your payments low. We're going to talk about SBA loans and credit lines you can get from SBA, even as a startup. A lot of people don't even know SBA has startup financing that you're able to get as well. We're going to talk about cash flow financing, no credit requirements, okay? No collateral requirements. This is money that you can get early stage in your business and still be able to get like up to $500,000 in funding. We're going to talk about how you can get equipment financing, equipment leasing, borrow against equipment you already have to get all the equipment you need for growth and expansion. We're going to talk about short-term loans, easier to get than longer-term financing, less qualifications, things you can even get as a startup business. We're also going to talk about merchant cash advances. Just because you have credit card sales or just because you're running money through a PayPal, a Square, a Stripe account, we're going to talk about how to use that as collateral to be able to get financing, even if you don't have collateral, even if you're a newer business. We're going to talk about how to get purchase orders fulfilled without you coming out of pocket with the money. We're going to talk about how to let your customers pay you on terms and then create the most valuable asset your business will ever have that will help you get SBA loans and also help you get interest rates as low as 1.25% or factor rates as low as 1.25% on financing using AR financing. We're going to talk about how you can get the money you need to buy inventory. Maybe you're an e-commerce business. Well, we're going to talk about multiple options today where you can actually get the inventory or get the money you need for the inventory that you sell online. So whether you have a Shopify store, whether you're selling on Amazon, or whether you just have a big retail business, we're going to talk about ways you could tap in and get inventory financing as well. We're going to talk about bridge loans to get you to bridge the gap between the money you can get now and longer term financing. We're talking about how to tap into 401ks and stocks and IRAs and bonds to be able to get money as well. We're even going to talk about how you can borrow against existing real estate or how you can even purchase existing commercial real estate with no money down. And we'll talk about how you can get up to $150,000 in credit lines with 0% rates for 18 months, even as a startup. Like I said, this is the ultimate video training today of a bunch of different ways that you can get money to grow your business. As I mentioned, a lot of these are available for you, even when you don't have credit issues, even when you don't qualify for a lot of other kind of financing and more. Thanks for coming in, Steve. Thanks for coming in from Facebook. Bismarck Sanchez, good morning. Thanks for coming in. Denise from YouTube, interesting. Wow, I appreciate you coming in. And Steve says 1.25% factory. Yes, we're going to talk about how to do it. And what's up? Facebook user is your name on my screen. So thanks for coming in, everybody from LinkedIn, Facebook, YouTube, and Periscope. So let's talk about term loans. So the most common type of loan is suitable for a wide range of business purposes. We call this working capital when you can use it for a lot of different different reasons, but it works very well for lots of different types of business expansion and growth. So with this, you basically have a set loan amount that you get up front because it's a loan, it's not a credit line, and it's where you're able to get longer term financing. So with term loans, you're able to oftentimes get financing as 5 years up to 15, 20, 30 years. Here's why this is important. When you want to get money and you want to keep your payments low, interest rates are secondary to term. Term matters more. So the key to getting low interest or low payment financing is to get long terms. And that's why SBA loans are so popular, because you can get longer terms, which keep your payments low. So with term loans, you're able to basically come in and get financing with longer terms, 5 years or longer, which helps keep your payments low. Now, the more time in business you have can help you, but it doesn't necessarily hurt you. So even if you're a shorter time in business, you're able to get approved. And a lot of this comes from traditional that are from alternative lenders. We're going to talk about SBA loans next. They come from conventional banks. So you've got all these alternative lenders that are in the space that offer these kind of term loans. And there's kind of this in between. You don't qualify for SBA loans through Chase, Bank of America, the big banks, but traditional loans or term loans are offered basically through alternative lenders where you can get these terms of 5 to 30 years. You can get interest rates of 8% or less. You can get approved with average credit, 650 type credit scores. They typically want you to have about 1 year in business, and it helps if you do have tax returns to actually get approved. You don't need any kind of collateral to get approved. So with average credit, and even like a year in business, you can start to get approved for longer term loans with these traditional term loans that are provided by all kinds of alternative lenders. Now, there's also SBA loans. And if you can qualify for SBA loans, these are the best types of loans you're ever going to get for expansion. And there's several different types that are out there. So the most popular type of SBA loans are 7A, which means you can kind of use it for any purpose, a 504, which is used for commercial real estate refinance or purchase, or you can get microloans, which are available for startups, where you can get approved for up to $50,000 even as a startup business with SBA. Now, 7A loans are the most popular type of SBA loans, and these are called working capital. They're used for just about any type of purpose that you can actually use. Now, this is the most recent type of loan that we got here at Credit Suisse, so let me give you an idea of the kind of terms you can get. So we got like a $325,000 loan from SBA. The approval process took about 2 months because we had problems on our LexisNexis credit report, mine, that we had to have fixed before we were able to really get what we wanted. And I talk about that on a lot of training because it's an important lesson on why you need to get your LexisNexis credit report. Our interest rate, I think, was like between 7 and 8%. And in the end, our payment ended up being about $4,500 a month. So it gives you an idea of term. We got a loan for 30-year term, $325,000. The payment's only $4,500 a month. So this is why people get SBA loans. You can use the money for a lot of different purposes. The term is long, the interest rate's fairly low, and it keeps your payments low. So great way to go. Now, you're going to guarantee the loan. You're going to have good personal credit. You're going to have established business credit. You're going to need some kind of collateral, and I'll teach you the most common type of collateral here in a few minutes that's used for SBA loans. It's going to surprise you because it opens up another funding opportunity while giving you an asset to use for SBA 7A loans. And you also need to have cash flow. You need to have 2-3 years worth of tax returns. This is where you want to end up. So even if you don't qualify for this, we want to get you there. And to get you there, you need to work on improving your personal credit, building your business credit. You need to work on getting some of this other kind of financing, which gives you assets in your business. And the other thing is you need to start claiming some kind of profit on your tax returns. The difference between showing a profit on tax returns and not showing a profit is a big difference in the kind of financing you get in the business world. So you want to start to show some kind of profit on tax returns when you want to start getting into SBA loans and longer term loans, because that's really what the lenders want to see, is that you have an actual profitable business. Now, 504 loans are basically used for commercial real estate purposes. You could typically get up to about $5 million in financing. You can use it for a lot of things, including actual equipment, but 504 are most common to purchase commercial real estate or borrow against it. Typically get loan terms up to about 25 years. You typically can get approved for as little as 10% down, and you can get other financing we're going to talk about today to cover your 10% down. So we see this all the time, where you go get a kind of financing like equipment financing or commercial real estate that requires a down payment. Then we get other kind of financing to get you the money to cover as the down payment. So the result is that you can use these loans in combination with other financing, and you can basically refinance a property, lower the payment on a property you're already renting now and own own the property, or you can even use it to basically buy commercial real estate, which is about to be hit rock bottom, I think, in the next couple of years. So you have some phenomenal purchase opportunities to purchase a building to keep your business in, purchase it as an investment property, or even again, refinanced against a property that you're renting to be able to actually own that property. So again, it can be used for equipment, many other purposes, but most common for real estate. Now, microloans is one of my favorite programs from SBA because you can get it as a startup. You can get the funding right from SBA, so you don't have to meet a lot of the requirements other lenders have. You can get approved with average credit. You don't need to have a lot of revenue or any revenue to really get approved, and you can get approved for up to $50,000. Now, the average loan amount with microloans with SBA is about $13,000, and the average amount of money that a startup claims they need to get their business off the ground is $10,000. So you're getting about 30% more than an average startup needs to get a business off the ground. And this works better for startups. If you're 1, 2, 3 years in business, you don't need a lot of money, then this is a great way to go. Terms are a little bit shorter than normal SBA loans, maybe 3, 4, 5 years, but you're able to get approved for about $50,000 with terms that are way more lenient than most kind of other SBA loans. So some really good options for growth and expansion. Now, cash flow financing is one of my favorite kind of financing, and it kind of went on hold during COVID because this whole kind of financing is based on you having consistent revenue. And if your revenue declines, like everybody's did or a lot of people did in COVID, well, then a lot of the lenders tighten up to see how this thing was all going to shake out. But what I love about cash flow financing is it's one of the fastest, easiest ways you're ever going to get money for a business, period. It just is. You can get funding usually in 72 hours or less. We funded people 24 hours. We funded them the next day so they could pay their payroll. It's easy to get approved. You don't need collateral. You don't need to have good credit. Some lenders have 500 FICO score requirements. Some lenders have no FICO score requirements. So it's pretty easy to get, and it's fast to get. The one thing they really want to see is that you have a responsible bank account management. They're looking at your bank account to make sure you have more deposits going in than money going out. You have a positive ending bank balance at the end of each month, that you don't have a bunch of non-sufficient funds where you're overdrawing the account. Look, if you are managing your bank account responsibly and you have about $10,000 a month in revenue and have been in business 1 year or more, this is a great program to qualify. It's fast, easy money. Terms are usually as little as 6 months, as much as 5 years, but it's a really easy way to be able to get money on the short term to take advantage of opportunities. And that's where we have a lot of clients do. We had a client that owned a soft drink manufacturing company, and he bottled it. He sent it out somewhere else to get bottled. He used this kind of financing to bring all the bottling in-house and radically improved his margins and his profits. So even though his credit was bad, his interest rate was high on this kind of financing, he got the money quickly and easily. He brought it in-house, and he immediately started making, or as soon as he brought the bottling in-house, it took about a month to do, he then started making substantially more money in profit than what the financing actually cost him. So I could go on, but it gives you an opportunity. Another one was a lady that owned a tow truck, had a one-truck tow truck business, and wanted to get like $80,000 to buy more trucks. Well, she only qualified for $8,000. So we use this kind of financing, very high risk, to get her first truck. She got another truck on the road, or she had one truck, expanded it to 2 trucks. She continued to then make more revenue. We got her more money, $30,000, $50,000, $80,000, and she now has a fleet of tow trucks on the road. She 10x'd her business in the course of 2 years using this kind of financing. So I can go on, but cash flow financing is a very popular way to get money because it's very fast and it's very easy. Okay, so, and it's very easy to qualify for. So equipment financing, I'm gonna talk about 3 different kinds of funding in this category, but equipment financing is basically where you're getting the money you need to buy equipment. Now, you can buy equipment even as a startup. You can get approved even when you have challenged credit scores in the 500 range. And instead of getting a credit line or a loan for the purpose of going out and getting equipment, use equipment financing for that purpose. So for example, a friend of mine came in, she was opening a new office and she was in the medical field and she needed a really big piece of equipment. She came to me to get a line of credit to buy that equipment. So what we did was we ended up getting a line of credit for her for like $75,000 to start her business. And I'll tell you a little bit later the exact line of credit she got to start her business, because you can get approved for up to $150,000 with that program. And then we got her equipment financing to buy that piece of equipment. She thought she was going to need the credit line to buy the piece of equipment, but we got her equipment financing. She needed the first and last payment down as down payment. We used her credit line to pay the first and last month's down. So here she was. Now she thought she was getting a credit line to get equipment. We got equipment financing for that purpose, and she still had this whole credit line that she was then able to use to grow and expand the business, and it helped her radically get the business off the ground and grow faster. So if you need to buy equipment for whatever you're doing, use equipment financing. If you've been in business 1 year or longer and your credit's better, 650 plus scores, look at equipment leasing. The payments are even cheaper. And if you have equipment that you already own free and clear, or someone around you does, well, then you want to consider what's called equipment sale leaseback. And that's where you can actually borrow against equipment that you already own. So it's a great way to either get the financing you need to buy equipment, to lease equipment, or to borrow against equipment you already own. Look, if you're getting value from this, do me a favor. Just hit the like button, hit the love button. What happens is that tells the social platforms to show it to more people, and it helps other people get this training. And then also don't forget to subscribe on whatever channel you're watching on so we can notify you when we release more of this kind of content. We're not even like a fraction of the way through this, and hopefully you've already got some pretty good ideas. So let's talk about short-term financing. The following data points are of interest to lenders and credit providers. Debt. How much debt is your business already carrying now? Debt is acceptable, but you need to be showing that you have the ability to repay and you have the history of repaying that debt. Okay, revenue. Lenders and credit providers want to see that your business is bringing in money. Now, lenders like SBA see it in the form of tax returns. Lenders like revenue lenders, they look at your bank statements. Okay, new artificial intelligence type lenders, they plug right into your bank account and their AI is crawling and reviewing your bank account. Primarily, revenue is verified through bank statements. So you need to manage your bank account responsibly. And then again, tax returns matter a lot when you start getting into longer term loans and when you also get into SBA loans. And some lenders may have minimum revenue requirements measured by month, quarter, or year. Okay, in particular, if you can also provide evidence of consistent business growth, that improves your chances as well. Look, everybody loves this. You can never forget that the number one thing lenders are looking at to lend you money is your ability to repay them. It's what they asked for all of this stuff for. Do you have a history of repaying your debts? Does it look like you can repay this new debt that they're going to give you? So what they want to see is that your business is doing well, not just that you're even, but that you're actually growing. And the more you're growing, the more they love that business because they can see that what you're doing is already working, and that significantly gives you a better chance of paying them back. So I wanted to talk to you about some of these things because these are the type of factors that are being looked at to determine if you should qualify for financing, how much you'll get, the rates and terms you'll get. So merchant cash advances are very similar to revenue lending. The difference with merchant cash advances is it's not a loan, just like revenue lending. You're basically selling future revenue, but they're easier to qualify for than cash flow financing. I know, I just told you cash flow financing, you need no collateral and you can get approved even with really bad credit. How could it be even easier? Well, I also told you cash flow financing, you need $10,000 a month in revenue. And I also told you need 1 year in business. With merchant cash advances, you only need 6 months of business. You only need $5,000 a month in revenue to get approved. And they're going to look primarily at your credit card transactions. So with revenue lending, or, they basically are looking at all deposits in your business bank account. With an MCA, they just look at what you process in credit cards through sources like Visa and MasterCard. Now, if you like this kind of financing, then you really want to look into PayPal, Square, and Stripe. First of all, if you're not accepting payments from PayPal, Square, and Stripe from your customers, you should, because they offer some of the easiest financing you're ever going to be able to get. So make sure you give your customers the ability to process payments through PayPal, Square, or Stripe, one of those options. Now, as well on that, then you want to look into those sources if you've been processing with them 6 months or more and talk to them about getting a loan. I told you revenue lending, merchant cash advances. I think I told you, maybe I didn't. You can get approved for as much as 15% of whatever you process in a year. So if your revenue is $200,000 a year, you can get a loan for about 15% of that, or about 30 grand. But with PayPal, Square, and Stripe, they'll lend you as much as 30% of what you process in a year. So if you've got $200,000 a month going to a PayPal account, for example, well, you could get $60,000 in financing, double what you can get with normal revenue lending and merchant cash advances. I love PayPal, Square, and Stripe loans because they're really easy to get. A lot of times they don't even look at personal credit or care. They're very cheap. Sometimes they don't even charge interest. They just charge like a $500 set fee. Sometimes they do charge interest, but it's not very much. It's just super easy money to qualify for because they're just looking, their AI is just looking at how you process transactions through them. And then if you consistently are processing money through them, they feel comfortable enough to lend you money to grow, so you process more money with them. So 3 other good sources on top of normal revenue lending and merchant cash advances that can work. Renee says, I use Stripe. Stripe is fantastic. And again, you need to check with Stripe directly on their funding options, because if you've been using Stripe for 6 months or more, good chance you can qualify for up to 30% financing of whatever you process through Stripe annually. So Renee, I would definitely check those out. Those fees, the fees are ridiculous. That could be. In a lot of cases, I like PayPal and I like Square loans because PayPal especially, you can get approved for as little as $500. But again, there are other risk factors. If you're newer to processing with them, if you don't process a lot, those things can tie in. So typically the qualifications for Square, Stripe, and PayPal have to do with how much money you're processing through them and how long you've been processing money through them. So if you've been processing money with them for not a long period of time, or you don't process a lot through them, that could definitely account for higher interest rates and fees. But the longer you're processing through them and the more you process, the better those fees get. Purchase order financing. This is a unique way to be able to get the money you need to fulfill purchase orders. And I always use the same example here. If you're a t-shirt embroidering company and you get an order for 10,000 t-shirts, that's fantastic. Congratulations. You got a massive order. Here's the problem. Now you have to go buy 10,000 shirts, then embroider them, then deliver them, then wait to get paid. So you're out of pocket a lot of money in between when you go to buy those shirts and when you actually get paid. Purchase order financing closes that gap. With PO financing, you're able to go get money up to 95% funding to go buy the actual shirts in this example. So you could basically fulfill those purchase orders and get 95% of the funding you need to do so, only 5% out of pocket. So what this allows you to do is it allows you to take these take on these major opportunities to basically take on new orders, not worry about coming out of pocket with money to get those orders filled, use PO financing to do it. Then when you actually fill the purchase order, deliver it, and get paid, then you can pay back the PO financing. So what I like about this is a couple things. It's a great way to get money. But the second thing I like is that it gives you a greater ability to grow your business. With this kind of financing, you can go out and chase massive orders when your competitors are scared to, knowing you can use PO financing to get the money that you need to be able to fulfill those purchase orders. So now you can go chase rainbows. You could chase the biggest orders that are out there, which gives you a huge competitive advantage to people in your industry that don't know about PO financing. Okay, and Willie says, PayPal, if your account is flagged, they could hold your money for up to 6 months. No bueno. Well, look, this is the way it is with anybody that processes just payments with you guys. You know, PayPal, Square, and Stripe allow you the ability to come in and accept credit cards from your customers. And so do merchant companies. Merchant companies that allow you to accept credit cards, they're all the same way, guys. I've personally had 3 different merchant companies hold my money for 6 months or more. And then some of them put permanent reserves on there. And then when I closed the account, it took me 1 year to 2 years to get my money back. Anybody you use to accept credit cards from your customers can and very likely will hold part or all of your funds for 6 months. So you need to read the small print. You need to know what risks you have there. And my suggestion is always have multiple companies, have multiple merchant companies, Willie, or use PayPal and then use another source and process money through multiple sources. But just so you know, PayPal, Square, Stripe, and every merchant company, you face the same risk. It's a real thing, especially when you're a newer business and you're uncomfortable. They're uncomfortable with your industry. So AR financing. AR financing is really cool because it provides you 2 main benefits. First of all, it gets you money. Second of all, it lets you make it more convenient for your customers to pay you. So what I mean by this is AR financing is where your customers can pay you on terms, but an AR factor or lender will get you the majority of the money in a short period of time where you don't have to wait for your customers to pay you. So let me give you an example. Let's say you let your customers pay you over 5 months' time. Well, that would mean you wait 5 months to get all the money from your customers, right? Not with AR financing. With AR financing, you can let your customers pay you over 5 months. That gives you the benefit of attracting more customers because you have more affordable payments for them because they can finance it over a longer period of time. But then what it allows you to do is the AR factor gets you 90% of that money in 24 hours. You let your customers pay over 5 months. The AR lender actually will collect the money directly from your customers themselves, and they'll give you 90% of the money in 24 hours. Then they give you 10% of the money minus their fees after they've collected all the money from the customers. The factor rates on these are as low as 1.25%. You can get financing for up to $20 million. To give you an idea, the biggest company I know of that does this is Johnson & Johnson, right? They're like huge. So Johnson & Johnson uses AR factoring as well. And again, you let your customers pay you on terms. You get up to 90% of the money right away. You can get approved regardless of personal credit. You can get approved if you're newer in business, and you can get approved even with no or little cash flow as long as you have account receivables. receivables. So, and again, this is the number one asset used to qualify for SBA loans. So the fact that you have these receivables that your customers are paying you opens up a phenomenal funding opportunity for you through SBA as well, because it can be used as the collateral component of getting an SBA loan. So inventory financing, many different things that you can actually get here. Now, inventory financing, as you can see right here with Investopedia, is a revolving line of credit or short-term loan that's acquired by a company so it can purchase products for sale later. The products serve as the collateral for the loan. Look, if you ever watched Shark Tank, I've seen people before that have a lot of inventory and then run out of cash. You should never have that problem. That's what inventory financing is there for. So if you need to stock the shelves of a new business, use inventory financing to do it. If you already have your shelves stocked, use inventory financing to borrow against the inventory you already have. You can get interest rates as low as 6, 7, 8% and get a line of credit for equivalent of 50% of the value of your inventory. Now, some other type of funding that's here is at creditsuite.com/inventory. And this is offered to Kick Further. I love these guys. If you've processed over $150,000 in sales on an online business like Shopify or Amazon, then you're able to actually qualify for crowdfunding to purchase your next inventory. So let's say I'm processing, I've got a doctor I had on my podcast. He has a solution for dry eyes. He has it manufactured, right? He's done $150,000 plus in sales. Now it's time for him to order another $100,000 worth of supplies. Well, that can cause a real cash flow crunch if he's coming out of pocket with that 100 grand to go buy the supplies to not sell or to slowly sell over the next 6 months. Well, if you go to creditsuite.com/inventory, you can access Kick Further. And what they'll do is they'll get crowdfunding in about 1 to 2 hours time. They will raise the money you need to buy the products that you need. So you use crowdfunding to buy the products you're going to sell. Then you pay back the money you borrowed as you sell the products. So what this allows you to do is it allows you to not come out of pocket with money to be able to buy your inventory. That helps keep your cash flow intact. Use that money for other things. Use this kind of crowdfunding to buy the inventory, sell the inventory, and then pay back what you borrowed. So a couple unique kind of inventory financing options that can work for you as well. Now, bridge loans are just what they sound like. They're kind of an interim funding to bridge the gap between what you can get now and what you'd like to get long term. So let me give you an example. I could possibly have talked about many kind of bridge loan financing for you right now. Maybe use cash flow financing as a bridge to get yourself to a point where you can qualify for an SBA loan. There's a lot of specific kinds of bridge loan financing that's out there depending on different purposes. Sometimes it's used by companies that are in between raising capital rounds and they're going to actually file for IPO. But let me give you another example. We've got a lot of clients that qualify for a program called Credit Line Hybrid. 0% interest rates, $150,000 in credit lines. Even as a startup, you can qualify. But the lenders in that space want you to have utilization below about 40%, meaning your existing credit cards, you need to owe about 40% or less of whatever your limits are. Some people don't qualify because they owe more than they should. Well, in that case, there's bridge financing where they will get you the loan on a short-term basis to pay off your existing credit cards. You pay them down or pay them off. You lower your utilization ratio. You qualify for Credit Line Hybrid. You go get 150,000 in credit lines. Then you use the credit lines you get to pay off the bridge loan. That's how bridge loans work. They are a way to bridge the gap. And that's a perfect example of how they work because there's a funding that you could qualify for, but you can't because you owe more on your credit cards than you should. But boom, bridge loan comes in. Bridge loan pays down credit cards. Now you qualify for what you were really trying to get, the $150,000 in credit lines. That's an example of bridge loans, but there are hundreds of different kind of bridge loans out there. They're popular in residential real estate. They're popular in commercial real estate. They're popular with companies that are getting money from venture capitalists and eventually are going to file for IPO. They're popular even, like I said, for revolving credit lines. So bridge loans are options that bridge the gap between what you need to do now to qualify for longer term financing. And there's a lot of options available in this space. Now, 401k financing, you can get less than 3 weeks. Interest rates of 5% or less. You get a loan or you can get a credit line. And you're basically using a 401k or IRA as collateral to get financing. So you can borrow as much as 100% of the value of a 401k or IRA. All you really need is a 401k or IRA worth 25 grand or more. You don't need any other kind of collateral. Credit doesn't matter. You can get it as a startup. And you don't need to have any kind of tax returns or cash flow either. So it's a really easy program to qualify. You can even use the 401k or IRA of somebody else. Maybe mom, dad, family member, friend has a 401k or IRA. You can plug into their 401k or IRA or your own to get low interest rate financing, regardless of personal credit, regardless of cash flow, and regardless of other kind of collateral. Now, with this kind of financing, it also has no tax ramifications because it's based on IRS proven strategy. It's kind of a rollover. You're just, instead of investing money in other people's businesses, which is what a 401k is, to investing the money into your own business. And because of that, and because it's based on tax proven strategy, there's no actual tax penalties with the IRS. Now, something similar to this as well is security-based financing. And this is similar to 401k and IRA financing, but you're using stocks and bonds as collateral. You could borrow as much as 90% of the value of the stocks and bonds, get interest rates as low as 5% on loans or credit lines. And here's the cool part. You still earn interest on the stocks and bonds. So this is great for acquisition of a business. It's great for business expansion as well. It's great for starting a business. And here's the best part. Doesn't need to be your stocks and bonds. Can be somebody else's. Here's why I say it's the best part. 75% of business owners, you hear this from me all the time, get money from family and friends. If I go to my dad right now to get money to start a business, I'm going to ask my dad for money, and my dad would sell or liquidate his stocks to get me the money that I needed. Okay. Now, my dad no longer earns interest on the stocks. He was earning interest. Now those stocks are liquidated to get me the money. But I could go to my dad and say, look, I need money to start a business. I want to use this kind of financing called securities-based financing. I'm going to borrow against stocks you already have, get a $25,000 credit line that I need. You still earn interest on the stocks and bonds. Nothing changes in your world unless I ever default on the $25,000. Then they would take $25,000 worth of your stocks. So I have a choice here. I can get the money from my dad where he's out the interest and he gives me the cash. And if I don't pay him back, he loses. Or he gives me no cash. He still earns interest. He just leverages the asset he has to get me the credit line. So it's way less risk for him to go with this kind of financing, which means it's easier for you to tap into family member, friends, and investors that have stocks and bonds, 401ks and IRAs, and let them use those assets to get you the money you need instead of expecting them to hand you cash. So whether you have 401k stocks, IRAs, or bonds, or somebody else does, these are 4 fantastic ways to be able to get money. Now, real estate financing for business expansion, you can also do a lot with commercial real estate financing. We talked about SBA 504 loans, but there's also a lot of hard money lenders. There's also a lot of alternative and soft money lenders out there. Fannie Mae, Freddie Mac, there's just so many options when it comes to real estate. Why does this matter? Because right now what's happening is landlords are becoming desperate. A lot of business owners are abandoning ship, right? And we had this happen. At Credit Suite, we didn't really need an office down here. 70% of our staff was already virtual. We decided with COVID, let's go 100% virtual. So we went to our landlord and we said, look, it's sketchy out there, man. Like anything can happen. We're going to give you a chunk of cash right now that we got from PPP, and we're going to buy ourselves out of this lease. And he did it because he was scared, because so many are scared. With this kind of financing, you're able to go in and buy commercial real estate. Now, we're seeing a lot of people buy the building they rent or lease and have a payment less than they're spending to rent or lease. As a matter of fact, most of our clients are using this financing to buy commercial real estate they currently occupy, right? They're already in that building. They buy the building. The building has other tenants. Okay, now they get more money in rent from those tenants, and their basic rent is non-existent. They went from having $10,000 a month in a rent payment to now earning $16,000 a month in rent, right? And so now the rent pays for their own expenses and they're profitable. They make a profit when it used to cost them 10 grand. A lot of people are doing this. And when commercial real estate financing and some of these other financing I've talked to you about combined, you're actually able to come in and you're able to basically get in with possibly no money down, buy the building that you're in. You can buy buildings for rental properties. You can also come in. You can use this kind of financing to construct new construction or build new construction as well. And on top of that, you're also able to come in and refinance buildings you already own and lower your payments. So a lot of different things that you're actually able to do here and expand. Now, another option, even though the title here is messed up, is equity crowdfunding. It's something else to consider as well. It's a great way to expand your business. So equity crowdfunding has come up over the last few years, and it's a way for private investors to invest into privately held companies. Now, I stress privately because this is what the stock market is. The stock market's people like you, private individuals, investing into publicly owned companies, but we own privately owned companies. So this gives us a way to get money for our privately owned business. And ultimately what happens is you're giving away a piece of your business, stock in your business, in exchange for the money. It's not money that has to be paid back like a conventional loan or credit line. With this, you're actually exchanging a piece of ownership interest in your business to investors that will then give you the cash to be able to grow. So again, it's kind of like Kickstarter, it's kind of like Indiegogo, but those are called rewards-based crowdfunding, where there's like a reward or an incentive for somebody giving money. In this case, the reward or incentive is equity. So ultimately, you're exchanging equity ownership in your business to get the money you need, but you don't have payments like you do for normal loans or credit lines. You can get this even as a startup. Your credit doesn't matter. Your cash flow doesn't matter. It's a type of financing anybody can get if you have a project that's going to be appealing to people that are interested in getting a rate of return. And crowdfunder is one of the best sources that you can go to for this kind of crowdfunding. So hybrid credit lines. So this is our credit line hybrid program, is where you can get up to $150,000 in credit lines, even as a startup business, 0% interest rates for 6 to 18 months. It's no doc. You don't need tax returns. You don't need bank statements. You don't need any of that stuff reviewed. All you need to qualify is a 680 FICO score or higher. They like you to have low inquiries, less than 6 inquiries in the last year. They like you to have lower utilization, lower than 40%. I already told you about a way that we could use bridge financing to lower your utilization if it's too high. The best way I've ever seen to get money as a startup, because you're getting up to $150,000 in credit lines. And the best part about this program is that you're actually able to come in and be able to get credit lines that report to the business credit reporting agencies. I didn't talk about business credit today, but it's another great way to expand your business and get the money you need for expansion. But with Credit Line Hybrid, you're able to come in, build business credit, which opens up more funding opportunities, and still, even as a startup, get up to $150,000 in working capital. Here's the best part. Okay, you can use a guarantor. You can use a family member. You can use a friend to qualify. So again, back to the dad example. If I go to dad to start up my business, say I need 50 grand, instead of you giving me 50 grand liquidating your stocks, why don't I use your personal credit to qualify this program called Credit Line Hybrid? I'm going to get credit lines for my business, but they only report on my business credit report, not your personal. So I get 50,000 in credit lines. I build my business credit. They report to my business credit reporting agencies, not on your personal credit. It doesn't adversely affect your personal credit. I get the 50 grand I need. And the only way you would lose out is if I default. They could come after you because you're a guarantor. So again, it's a great way to tap into family members, friends, and investors that have good credit instead of just asking them for cash, even if you don't have good credit. And the reason I bring it up, we do a lot of this. Last year, I don't even know last year how much financing we did, but I think it was closer to $30 million or something like that, $35 million for this kind of program. And half of that was for people that had bad credit that used guarantors. So this is very popular for people using guarantors to help them get the money they need. So a couple different creative ways for you to get money there. And Mark says, kind of like Grant Cardone style. Yeah, I'm not sure exactly what you're referencing there, but yeah, it could definitely be. Thanks, Mark. I appreciate you tuning in and making that suggestion. So recap, a lot of different ways to expand a business, right? Your best choice really kind of comes down to where your strength is. Is your strength cash flow? Is it credit? Is it collateral? Is it none of the above? That really determines which of some of these are the best options you can have. I mean, you might have consistent revenues that open up a lot of these options we talked about. You might have good personal credit. That opens up some of the options. We talked about business credit being good. And if your business credit is good, it opens up funding like SBA. So again, is your cash flow good? Is your credit good? Is your collateral good? What's your strength? That kind of determines the best kind of funding you can get. Now, if you want to open up the door to every kind of legitimate funding, if you want to see what you can qualify for, then give us a ring, 877-600-2487. Let me see if it's on our next slide here. Here's our phone number. And here's the reason I say that, because when you work with us, we never charge you any fee to get money. Never. We don't charge you up front. We don't charge you points in the back end. There is no fees ever paid to us. Sometimes the lenders pay us a referral fee. Sometimes they don't. Now, you'll pay fees and interest rates, stuff like that at banks. Just because you work with us doesn't mean all the money you get's free. We both have that common sense understanding that banks make money off interest and fees, but we negotiate that down for you. So we use this massive volume of funding we do to negotiate with lenders to get you better terms. So you get better terms working with us than directly with them, because we fund like tens of millions of dollars and you're like one customer coming to them for one low, and it never costs you money. You could just basically give us a call, connect with us. We'll tell you all the funding you qualify for. And whenever you need money in the future, you give us a ring and we're here to help you. We work with every legitimate kind of business funding. What I mean by that, I say it a lot, is that we vet a lot of different kind of business funding options. And the reality is a lot of them are not what they're made out to be. So we never recommend them. And a lot of them are, and we recommend them. The newest one we're recommending is a merchant advanced credit line where you can get up to $100,000 credit line, one credit line, no personal guarantee, reports to Experian commercial, not based on personal credit. It's just based on you having consistent revenue coming in through a merchant account, right? So that's the kind of newest opportunity we just started putting out there because we vetted it and it works well. It's over 1,000 different types of funding sources we work with, and you get our help for free. I mean, it never hurts. So give us a call to see what you can qualify for. When you give us a call, we do 3 things on a consultation. First, we do a fundability assessment. Look, there's a lot of things that you're supposed to do to set up your business the right way that you're probably not doing. And that's preventing you from qualifying for a lot of money you can qualify for. So we're going to talk to you about all the discrepancies on fundability and what you need to fix to get the most money at the best terms. We're going to help you get your business credit reports for free, $249 from the bureaus. We get them for you for free. We give you tips and tactics and teach you what you need to know to build your business credit. And we also qualify you for all kinds of financing on that one phone call. If you look at our reviews online, you'll see people rave just because of the consultation call they get with us. And there's 3 different ways to get that. You can give us a call, 877-600-2487. Email us, info@creditsuite.com. Schedule it yourself at creditsuite.com/consult. You can get approved for funding at creditsuite.com/get funding. And if you want to get our funding vault of 27 killer ways to get money for your business, visit us online at creditsuite.com/27 ways. It's the number 27 and the word ways. And that'll get you our funding vault of 27 different ways you can get funding for your business. If you like this, hit that like button, hit the love button, please. That's the one thing that tells the social platforms that this content was good. And that's the only thing I ever ask. Okay, I pour my heart into teaching and getting all the information to be able to teach it. All I ever ask is hit that one little like button, hit the one little love button, hit the share button to share it for people that you know, and then subscribe to our channels. If you subscribe on YouTube, click the bell beside subscribe, select all. That way you get notified when we go live. We go live Tuesday and Thursday at 11 o'clock on Wednesday, all Eastern time. And we have daily tips that we release on all different kinds of our channels, from Twitter to Instagram to Facebook to hundreds of videos on YouTube. You can even listen on the go to our podcast that's nearing 400,000 downloads, the Business Credit Financing Show. And again, one of the most popular financing shows that you're going to find on iTunes, iHeartRadio, radio.com that teach you everything you need to know about getting business credit financing. And we have all kinds of special people come on that are experts in their field that teach you all kinds of business growth strategies as well. So thanks everybody for tuning in. Please like and subscribe, and I'll see you on our next training where we talk about more cool ways to get money to grow your business. Thanks everybody. Have a great day.